Fidelity announcing this week that it will offer zero commissions on U.S. stocks, ETFs, and options trading. This is the latest brokerage to do so after TD Ameritrade, E-Trade, Charles Schwab, and many others made similar announcements just in the past couple of weeks. And joining us right now to discuss this trend in Fidelity's stand-apart model and evolving fee system for brokers, Kathleen Murphy is joining us, President of Personal Investing at Fidelity. And we're thrilled to have you here this morning, especially to discuss how what you're doing, I think, differs in large part from what a number of the other online brokers are doing. I know I made a comment yesterday in reference really to Robinhood, which I know is a competitor of sorts, and in terms of how they're paying for some of these non-commissions by selling some of their flow and data to folks like Citadel. That's something that Fidelity is not doing, and I want to be clear about that. But Kathleen, speak to us about this trend, what it means, and how you are paying for it.
You know, so we, as you noted, we announced yesterday, and it was effective yesterday, that in addition to offering the free online commissions, we're also making sure customers get value by getting higher interest on their cash, as well as best execution, which is the corollary of payment for order flow. So we do not take payment for order flow on equity orders. Many competitors do, to the tune of hundreds of millions of dollars for them. And we wanted to make sure in terms of this announcement that the three essential elements of a trading experience, the commission, the interest on your cash, and trade execution, that our interests align with our customers. And so in terms of how we're paying for it, it's really about offering overall value to our clients and making sure our scale not only benefits us, but benefits our clients.
When you project out your margins for next year, do they go down as a result of this move?
Well, in terms of our margins, you know, we are a private company, and so we make sure that our margins never get too high, frankly, because we're always trying to give a value back to the customers, whether it's zero index mutual funds, whether it's repricing the index funds. And so it's about us challenging ourselves to always both disrupt industry practices and offer more value. So we're really comfortable with what we did today, but we wanted to make sure in making this decision that we didn't sacrifice our customers' interest in how we did it. Right. Many of our competitors are paying for this by taking trade execution, you know, in terms of the payment for order flow from these customers to, as I said, to the tune of hundreds of millions of dollars per competitor.
So, Kathleen,
they don't give to the customer.
That's a real differentiation.
Yeah, sorry about that.
That's a real differentiation for what you're doing relative to the competitors. But I want to speak to that issue because I'm sure you had to think a little bit, or more than a little bit, about how you were going to approach this. And to the extent we were having a debate yesterday about what it even means for that to be taking place, and we always say there's no free lunch. How should customers think about when they are on a competitor site that does sell order flow? What is the true impact of that so people really understand it?
Yeah, and well, so very specifically, Fidelity, for example, we gave $17.20 on a 1,000-share order back to our customers on average. The industry average is $2.89. So we gave $635 million back to our customers. If you're going on somebody else's site, look to see if they even are transparent about their practices on payment for order flow. Do they quantify how much they give you back versus how much they take for themselves? That's really important. The other thing to watch for if you're on any site, Fidelity's or anyone else's, when you open a brokerage account, where do they put your cash and how much do they pay? In this rate environment, many competitors are offering as low as 0.1 for your cash. Fidelity took an alternative approach once again and said, we're going to default you into the higher interest rate option for your cash. So we're paying 1.58. Right. Competitors are paying much lower.
Hey, Kathleen, more broadly, just take a step back in terms of where you think the head of the average investor is today in terms of how they're thinking about investing, how they feel about the markets. I mean, the markets are a daily scorecard to some degree, but you see flows, you see where people are putting their money. What's your biggest takeaway right now?
You know, I'd say two things. You know, for our more actively engaged investors, when the VIX are up and there's volatility in the market, they get busy trading, and so we see them actually lean into these environments to some degree. The average investor that doesn't trade a lot, that's really just looking to save for their retirement, we have millions of customers like that. we've seen in the last few months that there's more money on the sidelines, more money's going into money market funds. I think, this has been a very sort of year of volatility and a roller coaster, and I think people are they're staying the course, which is great. They're not panicking, but I think they're in a little bit of a wait-and-see mode.
Right. Kathleen, your CEO is Abby Johnson, that is a fan of crypto, publicly so. How and when do you think people are going to be truly trading crypto on your platform in a meaningful way?
We're really careful about that. So while we've embraced crypto in terms of trying to understand it and be innovative and thoughtful, we're also very careful about where we offer those types of things. And so they're not offered broadly on the retail platform. We want to be very careful about making sure that investors that aren't institutional investors don't make a mistake with cryptocurrency.
Okay. Kathleen, come on back. We appreciate your time and perspective this morning.